Welcome to our discussion today on enhancing Australian investment in Canadian assets, basically understanding charity flow-through financing and its benefits. My name is Angelina Mehta. I'm the Director for Mining Investment Banking at Laurentian Bank Securities in Montreal, Canada. Joining me today is Lisa Davis, CEO of PearTree Securities, who will help us demystify the tax incentives that make charity flow-through possible, and Paul Fowler, who is Head of Corporate Development in Canada for Benz Mining. Benz just completed a financing, so we can use that as a concrete example.
Traditional equity financing model for the junior mineral sector in Canada has been transformed through a platform that enables investors across the globe to purchase equity to finance Canadian projects at attractive discounts to market prices. Most equity for junior mining companies is raised through offerings of flow-through shares. Some of you may be familiar with this financing tool, but many non-Canadians are not, since originally only Canadians could utilize flow-through shares to make an investment in a Canadian project. The flow-through share regime plays an essential role in attracting investment for exploration companies operating in Canada. This chart breaks down the equity financing completed through the TSX and TSX Venture exchanges for mineral exploration in Canada between flow-through share and non-flow-through share offerings. As you can see, on average, about 2/3 of equity capital raised for Canadian exploration has been raised via flow-through share offerings. Flow-through shares are simply common shares with tax features available only to Canadian resident share subscribers. The flow-through share regime permits issuers to transfer certain exploration and development expenses to subscribers of flow-through shares, allowing these subscribers to claim the deductions against their own taxable income. The type of expenses that a company may renounce in favor of flow-through share subscribers must fit within a definition of Canadian exploration expense. That is, expenses incurred for the purpose of determining the location, existence, extent, or quality of a mineral resource in Canada. Expenses incurred a little later on in the business cycle of a mining company also qualify for flow-through treatment. But the tax deduction of a flow-through share subscriber has to be amortized over time, generally 30% on a declining balance basis. These expenses are the costs of developing and building a mine, but do not include the costs of acquiring the resource property or any depreciable property. Now we come to the innovation in flow-through share financing that has become known as charitable flow-through financing. These transactions involve 3 simple steps. First, Canadian subscribers purchase flow-through shares. As the original purchasers, they are entitled to the tax benefits associated with the shares. The subscribers of the flow-through shares then donate their shares to charity, and they receive a further tax credit for the value of the donated shares. The charity then immediately sells the shares to a third-party investor. Since flow-through shares are simply common equity in the hands of a subsequent purchaser, the universe of investors is significantly expanded to include any global, institutional, and strategic investor. And because the value of the tax benefits to a Canadian donor is significant, the economics of the transaction can achieve the objectives of all parties with the sale of the common shares at a great discount to their trading price. The sale to the end buyer in the transaction will settle immediately following the issuance of the shares to the initial subscriber, so that the end buyer is in the same position they would have been in by participating in the offering directly. Let's look at an actual example. In the financing completed by Benz Mining last month, PearTree, on behalf of its clients, purchased units at a price of 87.5 cents per unit for gross proceeds of $13 million, a premium of about 24% to the previous closing price on the TSX Venture exchange. Each unit consisted of 1 flow-through common share of the company and a half common share purchase warrant. These units were donated by the initial subscribers, who retained the Canadian tax benefits arising from a purchase of flow-through shares, as well as from making a gift to a charity. Immediately after the donation of the securities, the charity sold the units to investors, mostly based in Australia, at 50 cents per unit, a significant discount to market. These end buyers acquired the same shares issued for $13 million for a total purchase price of approximately $7.5 million. The model we employ has grown and evolved over the past decade or so. We are now able to use this format in many different circumstances, including often bridging the valuation gap between issuers funding Canadian projects and foreign investors. Among the various applications, we also have worked with an ASX listed company to raise funds to finance a Canadian project, enabled strategic investments by producing companies trying to expand their project pipeline, and provided the financing required in an M&A transaction in which a financing condition was satisfied by the issuance of subscription receipts exchangeable for flow-through shares.
So there's a lot of information in that piece that we will be able to address in more detail through our questions, but I'd like to turn it to Paul first to discuss the Benz experience. For example, why did you choose charity flow-through financing?
Yeah, thanks, Angelina. Well, the answer to that's reasonably simple, actually. For Canadian junior exploration companies at the moment, or I should say, for companies with assets in Canada, this form of financing is by far the lowest form of equity capital that's available to them. And in addition to that, significant amounts of capital can be raised by using it. Now, equally as importantly, though, in our circumstance, Benz was in a position to use this mechanism due to a couple of very specific reasons. First of all, because the intended use of our proceeds was predominantly and exclusively to invest into the ground, into actual exploration, which is a mandated part of using this flow-through mechanism. And secondly, because we had a number of non-Canadian investors who were very actively interested in investing in our company. So they were the two ingredients in terms of why we could use this mechanism. And then referring back to my earlier point, the reason we did it is because it's a very low cost form of capital. I mean, just to expand on those 2 points very slightly, particularly the second one, because this is an important reason that we chose to use this mechanism. The management team that was brought into Benz very recently was actually one that many Australian investors will know, most prominently a chap by the name of Evan Cranston, who's our executive chairman. He's undertaken multiple successful recapitalizations of Australian listed companies, most notably Bellevue Gold and New Century Zinc. And so what that implied was that there were a lot of Australian investors that were interested in putting money into his next venture, which obviously was Benz. So ordinarily, it's quite difficult unless you have a Canadian listed account as an Australian investor to do that. But the way that we structured this charity flow-through financing meant that Australian investors could quite easily invest into our company without needing to go through opening of Canadian accounts. And also we had lots of Australian investors that wanted to put money in. So it enabled us to tap that pool of capital, as it were, which we wouldn't necessarily have been able to do quite as easily through traditional funding mechanisms.
So, Paul, just to maybe get into a little bit more detail, what you mentioned, a lot of retail investors, were there any other types of investors on your book for this financing?
Yeah, we had a lot of Australian retail investors, for the reasons we just discussed. There are also a couple of other larger institutions that were interested in putting in some capital from Europe. So I guess the point to make is that this mechanism allowed us to facilitate all of that, which is precisely what this charity flow-through mechanism does. It really means that if you've got a number of investors, be they Australian retail investors or institutional investors, or even strategic investors, for example, from any jurisdiction, any part of the world, if they're interested in investing in your company, you can effectively turn that demand into premium priced equity by virtue of this charity flow-through mechanism. So that's the reason that we did it, basically.
Perfect. And I know in the video, Lisa, you mentioned the actual numbers that went into the Benz financing. And specifically in this case, Benz is a TSX listed company. How would we address charity flow through, Lisa, if it was an ASX listed company?
Well, you know, it's only been done a couple of times before, and we were involved in one of those quite recently. The benefits of flow-through financing, and specifically charity flow-through financing, don't really change in terms of the marketplace on which the financing takes place. I mean, the rules that really govern the flow-through regime come from the Canadian Income Tax Act, and the key element to that is that the project has to be on Canadian soil. So the company actually that is conducting the work doesn't necessarily have to be constituted or listed in Canada, and the end buyers that Paul was just referring to don't have to be Canadian either. In fact, that's the beauty of the whole thing, is that you've really sort of taken two different agendas. The Canadian typically, at least traditionally, retail investor that wants flow-through shares that have those tax benefits attached to them, which are available only to Canadian investors. And you've left the underlying equity stripped of those tax attributes for a much wider universe of potential investors. So as far as the exchanges go, I mean, there's definitely good advanced planning that's required. I mean, there are differences in just the sort of process that you undertake when you do a private placement through a Canadian exchange versus the Australian exchange. It's a much more condensed process in Australia if you're used to dealing with things on Canadian exchanges. And there are structuring elements that just have to be planned for, because typically, and this isn't necessarily just an Australian issue, but typically the company which is issuing the flow-through shares it's the listed company, because ultimately the buyers want to have the shares that have a trading market associated with them, but the actual project may be held in a subsidiary. So there are structuring things to ensure that the flow of funds is handled appropriately to be eligible under the Income Tax Act provisions. But you know, it takes some advanced planning, but it's now been done a couple of times, and quite successfully.
Excellent. And maybe we could turn it back to Paul for a second. I know that you had mentioned Benz is considering an ASX listing. So what does that mean for your next charity flow through on both?
Yeah, it's a good question, and we'll find out some of the answers to that as we go along. We're actually in the process of listing on the ASX right now, and what are we now? End of November. So we should be launching the IPO within 2 weeks. I think the prospectus is being filed this week. The answer, as far as I understand it, it doesn't really mean anything in respect to making the charity flow through issuance should we do it again in the future. It doesn't really make it any easier or any harder, because this particular mechanism simply requires that you identify a number of interested end investors, as it were, and it can be in any jurisdiction. So the process of us actually listing on the ASX, I think it might make it slightly easier, but I'm not really sure of all the back-end mechanisms. It doesn't affect the fact that the actual processing of the charity flow-through transaction. What it does do is it means that we'll probably, in all likelihood, have a lot more Australian investor interest going forward, because we're an ASX-listed company as well, and we can capitalize directly on that by using the charity flow-through mechanism.
Right. And so, Lisa, does this mean it'll be the first time a company that's listed on both does it in your experience?
I think it may be. I mean, there's certainly never been an attempt to sort of utilize both exchanges in a single financing, that could be an interesting next step in pushing the envelope on this. But I think Paul's point is well taken, in that, just expanding that exposure to different pockets of investors is something that will be helpful within the charity flow through financing format, because we do open up the market to like a wider pool, and of course not necessarily Canadian investors. So it's all additive.
Right. Maybe if we could switch gears a little bit and address something that you went through in the presentation. I wanted to talk about what you commonly hear as the delta, or the premium that charity flow through shares offered to the issuers. It's not the same across the country, across Canada, I should say. And at least, do you want to talk a little bit about why and what drives that?
Sure. So the basic flow through share mechanism comes from the Federal Income Tax Act, and that's uniform across the country. But different provinces actually enhance that with their own provincial tax credits. So if we are dealing with a project in a provincial jurisdiction that has generous benefits at the provincial level, it expands that delta, or the value of the tax benefits in the hands of the initial Canadian subscriber that resides in that particular province. And the larger the bundle of tax benefits, the wider the delta, which means we've got more room to play with in terms of added value, which can be divided between a premium issue price for the company issuing the shares, or a discounted sale price to that ultimate buyer. As the promoter of the structure, we're indifferent as to how that spread is utilized, but what it does mean is that we're often able to bridge a valuation gap in a situation where, let's say, a strategic investor is negotiating to make a significant investment in a company, and they're as often will be the case, not seeing eye to eye in terms of what the valuation should be. So by bringing that delta into play, we can bridge that gap and satisfy the objectives of both parties.
Right on. Maybe I should point out, and I know it was presented in the slides, the delta, I believe, Benz, you achieved was 1.73. Paul, and just curious, did you get any feedback from the shareholders, or the investors, I should say, about, did they understand that? Was it difficult to get them over the line, or was it just that they're coming in at a discount and that was enough for them? You're on mute, Paul.
Yeah, sorry. Yeah, no. It's funny, when the investors that came into the financing did so at 50 cents, and as you can probably figure out from some of the earlier comments on the video, we as a company, we issued the stock at 87 cents, and at the time the actual stock was trading somewhere in the middle. So as you can imagine, most investors, upon hearing they're going to be receiving stock at a reasonable discount to market, are quite happy, and that's the end of it. I think a number of them were curious in terms of how we make that happen. And once you explain, it's all related to the Canadian tax benefits and the fact that we are beholden and obligated to spend the money on exploration. They're quite happy with that as an explanation. They don't need to know anymore why they're getting what seems to be cheap stock. But I mean, of course, the secondary benefit with that, which I suspect we will talk about at some other point during today's conversation, is that they also know where their money's going, because we're very much we're effectively committing to spending that money on exploration through this mechanism.
Right on. So we will come back to that just from an ESG perspective, because I don't think any discussion these days around mining and investment should not include ESG. But before we get there, I wanted to go back on something that you said, Lisa, around a strategic investor. So we know that what we call strategic investors, at least in Canada, are often producing companies that are looking to fill their pipeline. So maybe can you just take us through quickly some of the experience that you've had with Canadian strategic investors and their use of charity flow through, and then how that extends to strategics that are not Canadian?
Yeah, absolutely. I mean, look, as you know, in the broader picture, going back over the past number of years until quite recently, with commodity prices being so depressed, one of the first things that producing companies did was cut their own internal exploration teams. And of course, their pipelines of projects, are like, we're seeing the results of that now. So, the strategy of making strategic investments in junior companies in Canada has become more popular. And over the past few years, we've seen, very well respected companies globally utilize this structure in order to make those investments, and talking about things that have been publicly disclosed. We've got companies ranging from Tech to Agnico Eagle to Alamos, Newmont. I mean, these are all companies that have taken advantage of this structure. Now, mostly Canadian, but I think that's largely because just the flow through share regime in general is not well understood by those outside of Canada. There's absolutely no reason why strategic companies or strategic investments by producing companies outside of Canada can't be made on the same basis. And when you look at, in the case of Benz, so that was Quebec. So when we talk about differences across the country, I mean, Quebec happens to have very generous additional benefits. And so, to be able to, as a strategic investor, turn $1 into $1.73 to be used in the ground, I think is a very compelling reason for other strategic investors outside of Canada to consider this.
Yeah. And, if I could just add, I think the whole genesis of this panel for IMARC in particular was, what would be a topic of interest between Canada and Australia that would be beneficial to both countries, essentially. And so here we have a mechanism that is not as well known as we think it should be, because it gives the investor the ability to enhance, the capital invested, and it gives the issuer a way to minimize dilution using the mechanism. So I think, hopefully we'll get a lot of response from the conversation that we've had today in terms of finding out how more of all types of investors, not just strategic, but the retail and the institutions that we talked about, can participate. But let's go back to what Paul was talking about earlier with respect to the discipline of what is, flow through eligible, and why this is a tool that we can use to discuss ESG. Did you want to start again, Lisa?
Sure. I mean, I find that in talking to people all over the place that, one of the criticisms that has been leveled with respect to mining companies over the past number of years is that they haven't been the most responsible stewards of their investors' capital. And the flow-through share regulations ensure that the money that's raised is spent on a prescribed category of expenses, and those are expenses that are all within the exploration and development sphere. So there are rules that disallow the use of funds for overhead expenses and other things that may be seen as not being the most efficient use of capital in terms of driving a project forward. So there's actually a pretty regular audit process that's done by the Canada Revenue Agency, not
nothing scary, just kind of like a routine audit to ensure that the rules are followed, and companies that are doing exploration using flow-through share money here are pretty used to that. But you know, it does create that discipline on how the funds are used, and I think that's well received.
Paul, was that, you said that was important to your shareholders when they understood that there was a rigor behind how the funds would be used? Was there anything else that they were concerned about from the ESG perspective?
No, I mean, it's interesting. Not specific. I wouldn't say specifically with the investors that came into our issue on this round, but I mean, it's in my personal experience. Working in a number of capacities with mining companies, it's certainly something which is growing in importance. You know, I've come across an increasing number of funds that do require you to demonstrate your compatibility with ESG guidelines. So for us, this helps immeasurably. You know, we can point to the fact that we will and are committed to spending a certain amount of capital on exploration because of the way this type of financing is structured. And like I say, there's a number of funds out there these days that require you to make various commitments on ESG, whether it's how you're spending the money or your commitment to other criteria before they'll invest any money. So this certainly helps us do that to that audience, that's for sure.
So maybe the last thing, again, on ESG is, because this is charity flow through, maybe Lisa, could you explain how or what the benefit is on the charity side to whatever communities we end up donating to through this process?
Yeah, absolutely. I mean, you know, our firm was really founded on principles of philanthropy and giving back to the community. And I don't think ESG was as big a deal, you know, a dozen years ago, but, you know, we've really stuck to that core value. And I think that there's, you know, a recognition now that, you know, all of us in the mining community in whatever, you know, capacity we're here, should be thinking about giving back to the community. So, you know, we're satisfying, you know, two objectives when we raise money. We're obviously raising much needed capital in the junior mineral sector, but at the same time, those funds find their way back into charitable causes. And, you know, it's something that we think is really important as a company, and I think is getting more and more recognition.
Yeah, absolutely. And one of the things, you know, that I see as a banker, again, is, you know, the need for discipline, the at least discussion around ESG, but frankly, more and more different types of mechanisms to inject capital into junior mining companies in particular. So I think we're coming close to the end of our time here, but if I could just maybe summarize a little bit, and if you guys have, you know, some last minute thoughts, please wave your hand here. But what I was going to say is, one of the data points that I found really interesting was that 3/4 of Canadian financing for early exploration is done through flow-through mechanisms, whether that's charity or traditional flow-through. And most investors that are outside of Canada would not have participated in that without the benefit of having a mechanism such as charity flow-through. So I think it gives them the opportunity, obviously, to buy into these Canadian companies at this early stage. So, and we've already talked about the benefits of doing this methodology. Certainly, there are some process issues, as Lisa alluded to earlier, with respect to timing and logistics and just good planning. But I think there's been enough of them done to this point, both TSX listed and ASX listed, and across all kinds of different investors, including retail, strategic, and institutional, that frankly we should be seeing more of it. So maybe I'll leave it at that, unless Lisa or Paul, did you want to add a last minute thought? No, well,
you know, is that it? Are we over?
Go ahead. Sorry.
That's all right. No, I mean, from my perspective, I'd echo what you were saying there, Angelina. I mean, I think most people in my shoes would agree that helping to run if you're running if you're in the business of running junior mining companies at the moment, particularly in the exploration business, it's utterly necessary to scour as many sources of capital as you can, because a lot of the funding mechanisms for exploration companies are still gummed up due to a bunch of other factors we could spend hours talking about. And, you know, just to wrap up, this is one way by which we found a significant amount of capital that's going to help us move the project forward. And I think any exploration company needs to be actively looking for the cheapest and largest pools of capital, and this is certainly one of them.
Thanks. Lisa, any last minute thoughts?
I think we're almost out of time, but I would just like to say it was great working with Benz. That was, you know, I think that was a very smooth, successful cross-border transaction. And I think this is a very timely conversation because we, you know, we've also now done the heavy lifting in dealing with the ASX listed company utilizing this mechanism. So, you know, we paved the way to lots more.
Perfect. I think we are out of time now. Thank you very much.
Thank you, Angelina.